Trading profitability is tough. Most traders struggle to find the right entry and exit points because they can't actually identify where the market is likely to reverse or continue. This is a big problem. It leads to missed opportunities, losses, and frustration. But we can fix that with supply and demand zones. In this video, we'll show you how to find these zones across multiple time frames using one single indicator and how to find trades using them. Also, make sure to watch until the end of the video cause I'll share some secrets to avoid bad trades. So what are the supply and demand zones? They're areas where price tends to react because of significant buying or selling pressure. The issue is that most traders only look at one time frame when drawing these zones and miss the bigger picture. For example, a zone that looks strong on 5-minute chart might be irrelevant when you zoom out to the 1-hour chart. This limited view causes inconsistent results. Plus, manually identifying these zones across multiple time frames is time-consuming and prone to error, leaving you uncertain about which level actually matter. That's where the Flux Chart's MTF supply and demand zone indicator comes in. This tool actually identifies supply and demand zones across multiple time frames and display them on your chart. It uses two methods, momentum and regression, to detect the zones, giving you a clear view of where price is likely to react. It's designed to work for any trading style, whether you're scalping or swing trading, and it eliminates the guesswork by showing you high probability areas based on historical price action. Let's look at how to use the Flux Chart's MTF supply and demand zones indicator in practice. After you add it to your chart, it displays two types of zones. Red zones represent supply area where there are more sellers than buyers, causing the price to drop. Green zones represent demand area where there are more buyers than sellers, causing the price rise. This is the basic setup, and here's how you apply it step by step. The indicator gives you two solid options for spotting these zones: the momentum method and the regression method. The momentum method is awesome for catching those fast, powerful price moves. Take this example with the AVA USDT. That's avalanche against Tether on 1-hour chart. Here the price is making sharp jumps, and the indicator pinpoints supply and demand zones with really impressive accuracy. It's the kind of tool you want when the market's volatile. On the other hand, the regression method is great for spotting zones where pressure builds up slowly over time. Picture a 1-hour forex chart, like with the Euro USD example. That's Euro against US dollar. In this example, the market's moving sideways, just chilling in a consolidation phase, not trading up or down. The price is hanging out between two levels, a supply zone on the top and a demand zone at the bottom, both marked by the indicator. Here's how we can use it. You sell when the price reaches the supply zone where sellers are active, and you buy when it dips to the demand zone where buyers are waiting. It's a straightforward way to trade when the market's not in a rush. So if you're trading fast-moving assets, the momentum method is your go-to. But the slower sideways markets, the regression method shines. You can also adjust the sensitivity when using the momentum method with 4 options: high, medium, low, and lowest. Setting it to low or lowest shows fewer, larger zones, which suits swing traders who focus on major price levels. Choosing high picks up more smaller zones, ideal for scalpers. For example, on a 5-minute BTC USDT, which is Bitcoin against Tether, high sensitivity might detect a quick reversal zone in a volatile market. Personally, I go with the medium because it strikes a balance. It captures enough zones to stay active in the market without overwhelming the chart with too many small and significant ones, making it practical for most trading styles and conditions. Next, there's zone invalidation, which determines when a zone is no longer valid. You can select either close or wick. With close, a demand zone breaks only if a candle's closing price is below it, while a supply zone breaks if close is above it. With wick, the zone breaks if any part of the candle, including high or low, crosses it. If you choose close, it filters out temporary price spikes or wicks that don't reflect a true shift in momentum, providing more reliable confirmation of a break. I prefer close because it reduces false signals. Wicks can occur from random volatility or market noise, especially in fast-moving conditions, but the closing price shows a stronger intent from buyers or sellers, making it a better indicator of a zone's failure. To keep your chart clean, there's visibility range setting. This controls how far from the current price the zones appear. On a busy chart, lowering this focuses you on what's nearby, cutting out clutter. Another filter is minimum zone width, measured in 8-year average true range. Increase this and you'll only see major like a wide supply zone on a daily chart where big money is clearly at play. This indicator also labels key moments. When price leaves the zone and returns, green or red R label appears, marking retests. When a zone breaks, a blue B label shows up. For example, if a supply zone breaks on a 1-hour chart, that B could signal a long trade after the breakout. Personally, I choose to focus on trading breaks over retests. Focusing on one lets you master a specific approach, like becoming a pro at breaking out trading rather than trying to handle both and not knowing which to prioritize, especially when a strategy improves decision making and consistency. Let's break this down with the real example. The indicator has flagged a supply zone on a 15-minute price action chart for Bitcoin USDT. This zone is where sellers have been active, making it tough for the price to push higher. Now, check this out. The indicator didn't just stop there. It also gave a clear break signal when the price closes below the zone. That's your cue. A solid opportunity to enter a sell trade and catch the price as it drops. It's just a tool doing the heavy lifting for you. Another great feature of this indicator is that you don't need to monitor your chart constantly. Set up alerts instead. Right-click on your chart, select Add Alert, choose the indicator, and pick what to track: new zones, retests, or breaks. Then select your notification method, pops up, emails, or whatever you prefer. This keeps you updated without watching the screen all day. And finally, the multi-time frame feature lets you display zones from up to 3 time frames on one chart. For example, here's where trading on a 5-minute chart. I suggest enabling 15-minute and 1-hour time frame. If you're on 1-hour chart, choose 4-hour and daily time frames alongside it. I personally think having 2 extra time frame up is the way to go. Why? Because it gives you a wider view of what's happening with supply and demand across the market, not just what's right in front of you. Take this example on Euro USD 5-minute chart. Here's my tip. Focus on trading with the breaks or retest signals where zones from 2 or more time frames line up. When that happens, the signal gets a lot stronger and more accurate. And to get the Flux Charts MTF supply and demand zones indicator, click the link in the description or pinned comment below. It's quick to install and you'll have it on your charts in minutes. Start using it to spot high probability zones and improve your trading decisions.